Off to Victoria, BC for Daryl. Hello.
Yes, hello, David. You're one of my favorite people.
Well, thanks, Daryl.
I'd like to ask you about Qualcomm. I bought Qualcomm a little while ago at 76, and I'm not doing well. Should I stay with it or sell?
Look, there's 3 or 4 big semiconductor companies that are underperforming right now, and Qualcomm's one of them. They've had some difficulties getting paid in the Chinese market for their IP. There's lots of change taking place in the sector. The stock's been falling for a year. They're going to probably have negative revenue growth this quarter, and probably for the next 4 quarters. The expectation is that earnings are going to be down about 34%. It's not an expensive stock. It's $13, but I've rarely made money buying a value technology stock. I'd rather buy them when the ramp is going the other way. So I think you probably become a seller of this stock, especially given the fact that semis have come under a little pressure in the last few days.
So you much prefer up and to the right than down and to the right?
I like happy shareholders, right? Happy shareholders aren't in a hurry to sell. Valuations, the multiple investors are prepared to pay compresses as the numbers get worse, and the multiple expands as the number gets better. So that's a powerful dynamic. If you've got weakening numbers and a falling multiple, that's a double whammy that can lead to losses.
Don is in Ottawa. Good evening, sir.
Oh. Yeah, thanks, Mark. David, a bit of an aside, I enjoyed your comments on buying high. And I often get a little bit frightened when things get at their highs and I sell. But anyway, I've learned something at my great age. But anyway, my stock would be Citigroup. Your comments, please. Thanks very much.
Sure. I think Citigroup is a great buy here. At Barometer, we think the biggest change that's taken place recently is we think there's been a change in the direction of long-term interest rates. And with that comes a tailwind for financial services, especially the big banks. So Citigroup, I think, is an inexpensive company trading below book value. They're likely to start making money on their net interest margins. Technically, the stock broke out just 2 weeks ago to make a new high at 57. It's pulled back in off that breakout. The sector looks strong. I think you get very good dividend growth as we go forward here. They beat the estimate by 9% most recent quarter. They're coming up in the next 10 days or so, I think on the 16th. I'd buy the stock here.
In Winnipeg, we have PK. Hello there.
Hello. Thank you for taking my call.
You're welcome.
I would like to ask about Goldcorp. It has not been doing well lately, so is the gold price. But are there issues specific to the company that's keeping it in the penalty box? Thank you.
Right. So PK, Goldcorp has been paying down debt. Their cost of production is relatively low. It's like $600 an ounce. As far as an operational business goes, it's pretty good. The problem is it's just in the wrong sector. And our view is that you had a secular bull market in commodities from 2000 through 2012 on the back of a strengthening China. China rolled over in 2012. At around that time, inflation started coming down and you had the developed economies and developed markets take off. Probably equities in developed markets have 10 years in front of them with obviously corrections. And I think commodities, on the other hand, probably have 10 years of underperformance in front of them. So I would just steer clear of the group. You had the best possible world in the last 2 weeks for gold, and gold went down. All kinds of crises, bear market in China, people concerned about the euro, and gold couldn't get off the mat. I just think it's a mug's game right now.
We'll take a break in about a minute, David, but maybe you could flesh out your theory about the fact that you think we're in a secular bull market that could last years.
Yeah, sure.
No,
now.
Yeah, right
okay,
now.
Good.
Yeah.
Okay,
Right now, yeah.
So here's the thing. 2 things happen in a secular bull market. You have some big shift that takes place in the underlying economy. That causes not only earnings to grow, but as people recognize that it's a good thing, they're willing to pay a higher and higher multiple of earnings for stocks. So from 82 to 2000, the multiple for the S&P went from 7 times earnings to eventually by 2000 it was 30 times earnings, and it was too much, 100 times earnings in the NASDAQ. From 2000 through 2012, money slowly left equities for real estate, China, emerging markets, commodities, and the multiple in the market contracted every year for 12 years. So that meant people were becoming gradually more and more pessimistic. In 2013, stocks made a first new high since 2000, and the multiple expanded for the first time in 13 years. When that begins, it tends to go on for many years. The second thing is, in a secular bull market, correlations, or the degree to which stocks behave the same as the others, tends to come down as the leaders become clear and the losers become clear. And correlations in the S&P were over 90% at the end of 2011. Today they're around 50%. They're slowly falling, and there are very clear winners and very clear losers. Secular bull markets tend to go on for 10, 12, 14 years. Mm-hmm. There's interruptions, and there will be interruptions, but it becomes more a world of being prepared to hold things and stay with the leadership. It's less of a trading market.
And David has 3 ideas within this, what he thinks is a secular bull market for many years. 3 ideas for you right after this.